we find that audit failures reduce clients' market value and the auditor's ability to retain clients. Hi, this is Sheila Belda, and today I'm gonna talk about the consequences of audit discrepancies and how can best avoid detrimental outcomes from an audit. In our world, every organization or school's financial reporting would always be 100% error-free. Financial statements contain vital information about a company's health, and internal and external stakeholders need to be able to rely on their accuracy to make critical management and investment decisions with confidence. Unfortunately, inaccurate reporting can sometimes occur either due to unintentional error or, in the worst situations, deliberate fraud. Inaccurate reporting can have painful and costly consequences, including poor business and investment decisions, regulatory fines, and reputational damage. Understanding that causes risk and ways to mitigate errors can help companies avoid financial reporting inaccuracies and the problems they can use or they can cause. Now, let's start with the consequences of audit discrepancies. First, we have wasted time and resources. Companies can spend a significant amount of time trying to track down and fix financial reporting errors and dealing with the consequences. It's frustrating for everyone involved and can lead to strained relationships as well as job dissatisfaction. Is bad decisions. Inaccurate information can lead to poor decisions. This is especially important when it comes to internal financial reporting, which is often the basis of operational decisions such as product pricing as well as workforce hiring and firing decisions. Is cash flow problems. Over-reporting cash flow can cause the company to be short on cash when paying bills or payroll. Conversely, under-reporting cash flow can mean missing opportunities for investment income or interest. Is fines and penalties. Inaccurate or late reporting can lead to penalties and fines from the IRS or Internal Revenue Service and as well as the local authorities. If an IRS audit finds that a company underpaid its tax or taxes due to inaccurate financial reports, the company is charged interest and penalties on top of settling its tax bill. Fifth is reputational damage and loss of credibility. Inaccurate financial reporting undermines the credibility of school or a company and its management, even if the errors are unintentional. Lenders may consider that applicants with financial reporting errors are riskier and charge them higher interest rates or even refuse to lend them money. Investors become wary when they lose trust in a company's financial information. The stock markets are unforgiving when the companies need to resign or revise financial reporting, like share prices often fall and valuation sink. Sixth is bankruptcy. When inaccurate financial reporting is a result of fraud, the impact can be ruinous. Intentional misrepresentation of financial statements can result in a legal action, arrest, and imprisonment of executives, penalties, and fines. The SEC Division of Enforcement investigates and administers enforcement actions for these cases. In one prominent example, a major energy company was investigated by the SEC for inflating earnings or earnings report using deceptive accounting practices. As the full extent of the inaccuracies became apparent, the formerly high-flying company saw its stock price plummet from high of 900 pesos per share to less than 300 pesos. So the company ultimately filed for bankruptcy. Several executives were imprisoned and employee pension plans became almost worthless. In another example, a food manufacturer was accused of inflating its profit on key products and reporting inaccurate earnings. Although the company never admitted to any wrongdoing, its stock lost 20% of its value in a single day. Now, how can we best avoid detrimental outcomes from an audit? To manage risk adequately in an organization of any size, consider taking a top-down approach. This means that the responsibility is on leaders and managers to assess risk and communicate the strategy to the rest of the organization. Every individual should be made aware of the expectations involved and the overall culture surrounding risk. To do so, we can create a risk assessment matrix to aid in both identifying risk and developing risk management strategies for dealing with each risk. On to the risk strategy options. So, here are the four main types of risk mitigation strategies. First, avoid. If you can fully control the activity that involves risk, you have the option to entirely avoid the risk-causing factor. However, you also forego the benefits of undertaking said activity. Second is reduce. Minimize the negative effects or likelihood of the risk occurring. Many organizations utilize automation solutions to help mitigate various types of risk by streamlining processes. Third is accept. If risk mitigation strategies are more costly than the potential downsides of the risk occurring, it could be in your best interest to accept the risk. And fourth, transfer. Alternatively, you can transfer risk to a third party. Example, buy an insurance plan. This option comes at a defined cost. Now, what is a risk assessment matrix? A risk assessment matrix is a visual project management tool that displays all potential risks, the expected likelihood of occurrence, and the severity of the consequence should the risk takes place. When we have the risk assessment matrix, it becomes easier to prioritize risk and determine the strategy that's best suited to manage each one. So, why perform a risk assessment matrix? Just like auditors perform their assessment on the level of inherent risk and control risk, businesses should also manage their risk to the degrees that they can. To make it easier to visualize risk and decide a risk mitigation strategy, you can create a risk assessment matrix. And how to create risk assessment matrix? To create a risk assessment matrix, we can follow these steps. First, identify the risk. Involve members across departments as each person brings a new perspective and deep understanding of their day-to-day process. Second, analyze risk. Assign a probability for each event happening by performing quantitative risk analysis. Third, assess impact. We can use a 1 to 10 scale to define how much of an impact the risk would have on your business if it took place, or you can use a high-low rating system and categorize the outcome in terms of technical impact versus business impact. And prioritize risk. Based on the trilogy, you'll be able to clearly see which risks are more worth paying attention to through resource allocation and mitigation strategies. And that's all for now. Thank you for listening.